Welcome back. I'm Wes Wood, the Income Guy, and today we're helping you answer the question, what's my risk tolerance? And so far, we looked at what risk tolerance is and identified some of the factors that determine your financial risk tolerance. Now, let's talk more about the different levels of risk tolerance and how they relate to investing for income. As I noted, if your natural risk tolerance is high, you're probably more likely to invest aggressively. If so, we would have to say you have an aggressive risk tolerance. But, as we've also talked about, if your natural affinity for risk is only one of the factors that you might put into that category, we need to consider others, like your age, retirement timeline, your net worth, and your goals. If it turns out that you're slightly less aggressive after considering all these factors, we might have to say you have a moderate risk tolerance. And if you're in this category, you might be willing to take some risk in loss of principal, but with a strategy aimed to limiting that degree of risk. Now, the final one is the conservative risk tolerance level. And if this is you, then it means that you want very little risk of real loss if possible. So, how does all this relate specifically to investing for income? Like this. The conservative and moderate options on the right in the middle of this chart make up the universe of income-generating financial strategies. The aggressive options on the right are primarily growth-based strategies, and as such, they carry much more risk. Collectively, these tools illustrate just how diverse an income portfolio can be and how an income specialist can help you create a strategy right for your risk tolerance, whatever that may be. Now, coming up, I'll talk more about some of the dangers of ignoring risk tolerance. But right now, here's your another chance to get your copy of the Timely Report, 7 Risks to Your Retirement. And it's free with your Retirement Income Kit. And it's all yours by visiting retiretv.com or by calling my office directly at 826-5749. But now, let's welcome back Income Specialist David Scranton.
You know, Wes, it's interesting. You talk about the conservative and kind of the moderate side and then the aggressive side, but I think it's important for people to realize that the aggressive side really consists mostly of things that don't pay much in terms of interest or dividends. It's more growth or total return based. So those are things that you typically utilize in the earlier stages of your career, you know, when you're still a good number of years away from retirement, right?
Yeah, that's right. So the growth in the more aggressive things that we just discussed and looked at are typically more geared for those folks that are younger. They're not going to pay you much in the form of interest and dividends because growth is really equipped to give you returns by capital appreciation. You know, you hope to buy a stock or a mutual fund that's not going to pay you much in dividends, and you're keeping your fingers and toes crossed hoping that the share prices increase in value over time. But of course, we all know that the market may not go up, it could go down. So the share price, instead of growing in value or appreciating, could turn into a loss. And along the way, it's not going to pay you much in the form of interest and dividends to get your return. So the idea of growth is you got to have the time on your side to ride the ups and downs of the market. And over the long term, some of the growth strategies may be a good way to invest as long as you have the time on your side.
So we've got the bookends, right, that people know about. They've got the accumulation time of your life when you're more growth-based, the income time of your life, which is obviously when you're more income-based, right? But in some ways, the most important part is getting it right during those transition years. So, you know, if you could talk about those, I think it'll be helpful to your viewers. And also, how many years before retirement do those transition years really begin? Because I think the answer will surprise a lot of people.
Yeah, the transition years, to answer your last question first, the transition years is normally we see it between 5 to 10 to 15 years or so from retirement. And what we say transition years is the years where you want to transition. You want to make a shift. You want to make a shift from growth to income. And there's many reasons we want to do that. Not only can it maybe mitigate some risk in a portfolio, but now the portfolio is focused more on interest and dividends and investments. And investing for income is typically more in line with folks that have goals that are income based. Folks that are retired are really looking to generate income in the form of interest and dividends in retirement. So when they're spending their interest and dividends in retirement, they're not depleting their principal. They're just spending what it's generating for them. So we want to get that money invested more in income during those transitional years to align it with their current goals. So we say again about 5 to 15 years out is typically a good time to consider it.
And what I think people need to realize, if you focus on the 5-year point, you're really gambling. From 2000 to 2013, the market was underwater for 13 years. So, if you're retiring in 2013, it would have behooved you to make that transition 13 years earlier. But I want to stress that making that transition doesn't mean getting out of the stock market. You can still be eye-focused or income-focused even in the market. It's just that you can't use the traditional growth-based strategies that maybe you did use in your younger years, right?
Yep, that's exactly right. So it doesn't mean you're just going to take it all from growth stocks and throw it all into individual bonds. Although individual bonds are a great cornerstone of the eye, you can still invest in the stock market and take advantage of some of the growth of the market. But along the way, if you're investing in the stock market into stocks that pay dividends, value stocks that pay dividends, you can also get a great return there, which is actually a nice combination in our total return formula. TR equals I plus G. You're investing for income because you are getting interest and dividends from those stocks, but also maybe a growth component. And keep in mind, if you're investing in stocks that pay dividends, even when the market, where there is more risk there, even when the markets go down, maybe those stocks do go down in value, but you still have those dividends that are being generated from those stocks. And the benefit of that is you can now take those dividends, if you're not yet retired, and reinvest it into the stocks when they're a little bit down, which gives you kind of a natural dollar cost averaging back into the market over time, over that 10 to 15 year period before you do retire.
It gives you great dollar cost averaging because, when you're young and you're putting in $5,000 this year and you have $20,000 in the account, that's a huge dollar cost averaging benefit. But when you have $1 million, you're putting away $10,000 a year. That $10,000 doesn't do much to help you with that dollar cost averaging. But what amazes me the most, and what I love and respect so much about you and the way you run your business, is it takes extra work to be in the stock market investing for income than for growth or momentum. Most people look at the financials and the statements and read a couple articles. They decide if they like the stock or not. But to be an income investor in the stock market, you have to go a lot further than that. You got to talk to analysts. You got to talk to shareholder service departments at various companies. And that's work that most advisors are just too lazy to do. And fortunately for people in Nashville, you're not too lazy to do that.
Right. Definitely not. Thank you, Dave, for saying I'm not too lazy to do that. Yeah, we don't want to just do cookie cutter growth strategies. That's not the way to invest for income. But thank you again, Dave, and stick around. And coming up, I'll talk more about the potential dangers of ignoring risk tolerance. I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show. Hi, I'm Wesley Wood, host of the Retirement Income Show, and I'm founder and president of Wood Financial Group. And we're a local independent financial services company that specializes in creating custom retirement solutions tailored to meet your particular needs.
Visit retiretv.com to learn how we can help you create a customized retirement portfolio.